So generally speaking, when price is moving between an internal range and an external range, we would consider that to be a pro-trend continuation of the market. Meaning, if the market is in bearish order flow, right, and it creates a displacement lower, what it will tend to do is draw back into inefficiency before continuing the displacement move lower. So this is going to be a very classic internal to external range liquidity move in the market, very classic continuation. Now, the expectation for continuation is fair value being offered in the market, i.e. a return back into a premium array, in addition, right, to liquidity being sought. So that's going to be the end point of distribution. Now, this narrative will change in a market that is not trending. In a market that is not trending, you will see either two types of price action. You will either see what we know to be known as a stable consolidation. And a stable consolidation is simply another way of saying the creation of a range. So a range in the market, as we've learned, is going to be the origin of a price expansion higher. All moves in the market start with consolidation because consolidation is what creates higher time frame pivots. This is going to be a swing low in the market, right? When price is not displacing out of a range and instead consolidating, like it is here, right? These candles on a higher time frame are creating an external range low that will act as a point of liquidity or accumulation for a move. Now, generally speaking, right, we can say in this type of price action, which is going to be known as a consolidation or a range, that the hierarchy of PD arrays is not going to be the same as in a trending market. Meaning if we have internal range liquidity, someone is echoing. I'm going to quickly mute them. Oh, it's you, Ramsey. I'm going to quickly mute you. Sorry about that. So when price is ranging, you'll see that internal ranges of liquidity will not be offered and respected. Instead, the market will generally move and offer both sides of the market, known as external range to external range liquidity, which is often why consolidations don't exactly look like smooth edges. What they really end up looking like, which is a more common form of what you would probably see in a consolidation, is something like a broadening formation. Now, broadening formation is a form of consolidation where the market is seeking external range lows and external range highs. Now, in this case, when you get into these conditions, right, the internal range gaps are not going to offer pro-trend continuations lower. Instead, range deviations are going to be met with an opposing range target. And you will see this frequently in your trading. An example is going to be today, which turned out to be a very good example of a broadening formation. Ideally, we could have expected this because Monday was a short day. So what Tuesday did with high impact news was take out both sides of the market. And what we did was we broadened the formation of this daily expansion range that occurred on Monday. So Monday expanded, and then we broadened the formation, or we formed an inside bar to this range, taking out both sides of the market. Now, in this range, it's important to recognize that PD arrays will fail because the expectation of price delivery is not expansion. So you can see a bearish fair value gap fails, a bullish fair value gap fails, a bearish fair value gap eventually ends up failing, right? And on the lower time frames, you'll see analogous arguments, meaning that this range is offering, right, reversion. Hence why you'll see me draw out broadening formations and say opportunities lie at the extremities. With the extremities, you can seek mean reversion. Now, it's important to consider that in the context of your trades, because if you can recognize consolidating ranges, you can trade them. There's one other type of scenario in terms of institutional order flow where the PD array matrix changes fundamentally its delivery. And that is based on the premise of liquidity imbalance theory. So that would be in the case where price has reached a target of institutional order flow, importance. So we've already discussed one type of market condition. When the market is trending it will refer to imbalance, right, to target liquidity. A move back into imbalance will create a local swing, and it will create a liquidity point or target, right, in the direction of the daily draw, weekly draw, hourly draw, regardless. So if this is, right, our opening high, low, close, and this is, 0.0, this is going to be terminus, right? Any deviation below into an imbalance will create a new swing that will be used as a target in the direction of the DOL. And the market is efficiently generating buy stops in line with the draw on liquidity, which is why when you trade, you have high probability expansions, because this is the only target for you. You don't need to target, right, this draw on liquidity. It's a bonus or a runner. You get to target the local swing point that is created as a function of an internal range retracement, which is very interesting. But when the market is not moving in a trending fashion, like we also discussed, we will find that there will be an invalidation of this kind of thesis. Instead, the market will seek liquidity that rests beyond imbalance of the range. Instead, it will seek reversion back into external range liquidity. Take out a high, take out a low, take out a high, right? And we can see that here. Take out a high, take out a low, take out a high, take out these lows with SMT right here with the YM. Now we come in the end of the day, we take out this high, and now where's the target? This high, or this low, and this high. So you can see the entire day was chopping. And if you use this type of trending market analysis, or you use, right, this institutional order flow characteristic, which would be trend, you'll get burned. The market's not going to act that way. It's going to do confusing things. Now compare that state of delivery, right, that we saw today with the YM, and you'll see a very clear difference, right? It's doing exactly what we said it would do before in the state of trend. Institutional order flow is being respected in the direction of the draw. What is being disrespected? The PD arrays that are being created, right, against the institutional order flow draw and liquidity, which is lower. You can see that bearish arrays are being respected and bullish arrays are being disrespected. Very different form of price delivery than what we saw in NASDAQ. The other time where you will get an invalidation of the PD array matrix, which looks something like this, right? Rejection block, external range liquidity, mitigation, breaker, OB, FEG, EQ, and then we keep going, right? Again, this is going to be, if you look at a price leg, there will always be this matrix of delivery. You'll start with a rejection block or external range liquidity, probably above that. Then you will have a mitigation of the market. When price moves higher, you will be offered an order block, a fair value gap. There'll be equilibrium of the range. And then price will reach into what? External range liquidity on the other side. Right? It will trade through the breaker on the other side, eventually reversing, and then you'll get this on the buy side of the curve, right? So say, for example, in a trending market, let's look at this PD array matrix. We will start with a rejection of the ERL or a rejection block. In this case, it's a rejection block because we have an SMT, right? Here is our rejection block, right? And the wicks come into this area on a higher time frame, like the 4 hour. Let's look at that. Well, on the 4 hour, you'll see. Right, here is our rejection block in here, right here. And then we get an SMT. And now we are going to see how price delivers through each of the PD arrays, disrespecting the other side of the curve. We will now close through this down close candle, which will be our breaker, right? Series of down close candles. This move up will be the last failed order block, failure swing. Breaker will be offered, fair value will be offered, order block will be offered. We'll keep trading. Here is another mitigation block, which will be offered by the market until the external range high is met. Now, this is the continuum of price delivery. Once price reaches into its objective, which is fractal, then we can expect the continuity of that PD array matrix to fail. So there's a reason why ICT defines a PD array matrix and says some PD arrays are more important than others. If you're reaching into an external range high or low, the order block is not going to save you. What does that mean? If price wants to reach into this high, this array will fail. If price does not want to reach into this high, what will this act as? Well, look at how price interacts with the order block on the sell side of the curve. Here's our change in state of delivery, overlapping our fair value gap, overlapping our breaker. Look how price refers to these as institutional resistance on the sell side of the curve. Once price liquidates the area of institutional interest, right, order flow will shift, and that's what we call and refer to collectively, right, as market maker model traders, right, and SMR. A smart money reversal is nothing more than an institutional script that is now going to be flipped from bearish delivery to bullish delivery. Now, when this script flips, we utilize the function of inversion to benefit our thesis. We do not expect this array to hold. And the same reason why today on the 5-minute chart, you'll see, I put a note of this earlier in the premium, right? Look how similar the price delivery is in here as it is to here. You're seeing the implication of order flow shifting in the market. You're seeing inversion being offered. Inversion is a form of early market structure shift because it's the failure of the last bearish PD array into our area of interest. It's even better if it remains unmitigated on the leg down. Why? Because price has offered sell side and this array has no reason to reaccumulate and redistribute. So if it's never been mitigated, it will be a good draw for inducing short sellers, which it was this morning. Likewise, notice how these arrays in here are unmitigated and will not offer resistance, but rather offer institutional reaccumulation. Look at where price will reaccumulate inside of this price leg, right? So essentially what I'm trying to say is when you reach an objective, an institutional objective, this is institutional order flow, not retail order flow, meaning it's not going to be just a random swing low. It won't be. It'll be a specific pool of liquidity inside of a higher time frame array. What's that array? 4-hour fair value gap, right? With SMT. If there's not an SMT inside an array of interest, inside of a specific time-based pool of liquidity, that's not institutional order flow. But thankfully, we use the higher time frame charts and we track these things. So when we get that reversal signal, that is when your PD arrays will start to fail. That is when this inversion fair value gap is not something you would expect to short, because what you're noticing is the market is doing exactly what we said, right? In a consolidation range. It is creating a range high. Look at the market. The market is creating a range, deviating it, and expanding to the external range, taking out the sell stops, targeting the buy stops. Then it's consolidating, expanding, taking out the sell stops. The target is going to be the buy stops. This internal range here has no narrative because the market is not trending to an institutional target. In fact, the day on NASDAQ was bullish. And you can still see how this is reacting, right? There's no reason for the market to trade outside of this dealing range, which is going to be right here. Let me go with time frame and show you. And I talked about this on stream this morning. The dealing range is defined. We're not trading outside of it. So what we're doing is we're creating an internal range. And inside this range, there's no objective. The objective is internal range liquidity. That is the objective. So when we deviate a high, if you're still bullish, you don't want to be looking to trade long. What you want to do is wait for the deviation of a low and then trade to the range high that's created. And this will continue until we get what? A break of the range. Look at how we fail to break the range. We're not breaking out of the range. We will not do that yet. We'll do that on Thursday, most likely with news. But when we break out of the range and then we create an efficiency here, that's when there'll be an institutional target. What will it be? Daily external range low or daily external range lows, right? There's two targets inside of the range. We don't know which way it's going to go yet. And right now, YM is already showing us it's already going much lower. So, quick lesson turned into a bit of a longer one, but the point is understanding where institutional swing points exist and where inefficiencies will fail is critical, because if you're shorting this inefficiency, That's valid. But if you're shorting it after this draw has been liquidated, it's invalid. So even though this array holds, the thesis to short here is far less viable than the thesis before the institutional point of reference is liquidated. And you'll see that time and time again in the markets as we continue to observe how price reacts to gaps once the draw on liquidity has been met. Right? So we'll do another example right here. Same thesis. The institutional draw on liquidity has been met. A rejection block in the market has been established. A rejection block is usually accompanied with what? SMT, because one index is going to liquidate the external range low. The target is not retracement reversal. So if we look at market cycles, we are not expanding, retracing, and then continuing. The target is going to be the external range highs. That is the draw on liquidity. This is not going to be used for reaccumulation of the market. Likewise, that same applies for the bearish case, right? Or the bullish case, rather. Let's look at a point of interest, which we can clearly see is invalidated. This series of up-close candles presents inefficiency here and here. The invalidation of these inefficiencies is because the range is not, the institutional order flow is not designed to reaccumulate, redistribute. We have now purged the range high, formed SMT with the YM. The target is not internal range liquidity. It's not these gaps. These gaps, like I said, are better left unfilled because they're breakaway in the expansion and they will be used to induce longs in the market. Until what point? Look, all of these gaps will fail. Until what point? The institutional draw is met, at which point this internal range is not the draw on liquidity, which is why I longed on Friday. This is no longer the point of reference. The market is now going to be seeking liquidity. These highs, these highs. As you can see, the market offered liquidity with SMT and then failed to close above the range and then turned into the second profile, which we know for rejecting PD arrays, which is going to be consolidation. So here you're seeing both examples. When do PD arrays fail? When price is not moving like this, PD arrays will fail, right? When price is either moving like this, reversal profiles in the market, SMT, SMT, higher time frame array down here. This is the indication that this will become an inversion. Case one. The second case is when the market has no liquidity objective inside the range, i.e. we are not moving from swing point to internal range to swing point. Instead, we are moving from swing point to swing point. And this is all fractal. So inside of this range, you will see the same pattern emerge on multiple time frames. So if I look at this and I put a really light box, and then I zoom in, you will see the same pattern form inside of these ranges. So we will offer sell stops, we will offer buy stops. We will offer sell stops or buy stops, we will offer sell stops. Here, 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 maybe down here again. Until we deviate the range with expansion protocols. What's an expansion protocol? Higher time frame PD array like we saw this afternoon, and SMT. Until we get something like this, right? And then we see PD arrays being respected. Look at this 50-minute chart right now. Oh, my Wi-Fi's a little bit slow, sorry. The 50-minute chart, look at the invalidation of this array. Again, we're not getting any confirmation that price is expanding. Instead, we formed SMT at the highs, failed to close above the PD array of interest, right? We have no invalidation of this range, and now we're returning back into the range. So trading this becomes a game of seek and destroy. And then you can notice it by drawing out a broadening formation, right? But the thesis is going to be, the reason why people draw these broadening formations, it's a way for them to track where the external range targets are. Okay, so does that answer a bit of your question, Chitra, about like when to expect PD array failures?
Mm-hmm. Yeah.
Yeah, it's really important, and we'll do a lesson on it because institutional order flow only is two phases of delivery. The market is either one, accumulating, or two, expanding. Reversals and retracements are a form of expansion. And once you can identify the conditions of your market, then you can identify the conditions of your entries. In the same way that when we have a delayed protraction, something that looks like open, decline into the New York session, and a bullish draw on liquidity, you're not going to wait for all of this range to be retraced. In fact, if you look at my protraction PDF, very often delayed protraction will offer you something that looks like this. Meaning you will have to actively be fading this inefficiency that exists. Whatever imbalance on whatever time frame, it's all fractal, this is, you will need to trade against it. Likewise, when the market is offering a Judas profile, open, so again, an open, high, low, close can look like many things. It can look like open, low, high, close. This is a classic buy day where this London session forms the low. Then we get a new, inside of here, it looks like this. Right, we get a New York continuation, generally keying off of the Asian breaker. Very common profile in the market. Study this day and you'll see. Open, low, high, close. This fractal of price is the reaccumulation of the New York session off the Asian session breaker. And that's one way to deliver price. Another way is going to be open, low, high, close, which will require you to fade this imbalance because you'll have to expect that the draw on liquidity has been met and offered before the New York session. Another form is going to be a Judas profile where you have open, rise, sharp decline, sharp incline, because the draw on liquidity is up here, right? We have a failure to manipulate the daily range. You'll have to fade again this imbalance, and it will be a steep imbalance. A Judas swing generally looks something like this. Let me find an example for you to prove to you how sharp a Judas swing has to be sometimes. Look at this. Very classic Judas profile in the market. We have an open, and we fail to manipulate the daily range. You will need to participate in this price leg by actively involving yourself inside of these down close candles, or ideally at the first point of lower time frame reversal, which means you're fading inefficiency. This is all sell side imbalance because the Judas swing is the imbalance that's being created, and you'll have to target these highs. Essentially exactly what we did today, a little bit different in terms of whether it was a Judas swing because we had this buy side offered in London. So essentially we knew we wouldn't trade above this high, but our profile looked like this: open, high, low, and we were trading low to close. So this move is what we traded. Oftentimes you will have to identify where you are in your daily power of 3 to understand, do I want to trade against that fair value gap? Yes. Other times you won't want to, like on Thursday of last week, where you definitely will not want to because the market is offering you a open high and New York opens in the price leg that's creating the low. And then it closes the day here, right? Here is not a day where you want to fade this move because the institutional draw on liquidity is lower. But if you know where the daily candle is going, which is why I teach all the other things, there will come times where you have to fade that internal market structure, internal to the range, right? This range. And there's multiple ways it'll present itself. I think the Judas is probably the easiest way to visualize what that looks like because you can see it so clearly on your charts, right? You can see very, very clearly this Judas swing, right? Open, fail to manipulate the range. The range is going to be this low resistance liquidity. Oops. This LR. Fail to manipulate it, right? London gives a false rally. What do we create? You'll notice we create a devil's mark at the midnight opening price right here, or 1 a.m. rather. So the daily candle at this point looks like this. Now you will be required to recognize that the draw isn't these lows, but instead it's these highs. And you will do that by looking at institutional market structure. You will do that by considering everything I've taught you about internal, external range, higher time frame order flow, what's being respected, what's being disrespected. And when you see the Judas swing, when you see this, you will have to fade the lower time frame inefficiencies in here, and you will have to trade against them in a very similar manner to what we did today. But it wasn't as obvious. Today was less obvious because we didn't have as clear of a daily draw because of what the market profile looked like. But same thesis, right? This is lower. Look at the 50-minute chart. We actively traded, like on stream, we actively traded into this 50-minute gap, expecting, right, the draw to be these highs. So yeah, that's a mini lesson. There's definitely a lot to talk about there, and it really comes down to understanding like two concepts in more detail, which is going to be power of three, really talking about the daily candle and also the 4-hour candle, because generally you're positioning yourself around the 4-hour candle opens. 9 a.m. is close enough to a 4-hour power of three. You can also look at it as an hourly power of three. And if there's 8:30 news, you're definitely going to want to look at it as a 4-hour or 1-hour candle power of three. And in addition, right, to what ICT calls institutional order flow, which is what is being respected. That's the easiest way to say it. Is like what is being respected, what is being disrespected, and where does price want to go. That's stuff like we talked about on the daily chart, right? Like where we clearly saw last Thursday, institutional order flow was giving us signals for a higher Friday, closing below previous day low, forming SMT inside of a key area of interest, daily fair value gap, right? And also offering us a classic buy day before the market opened on Friday. So we got this indication in here, gave us the knowledge or insight to expect this gap to invert. Okay.